My $115,000 growth stock portfolio was down $6,800 in the month of October. In this video, I'm going to show you my entire portfolio, every company I own. I'm going to talk about the history of stock market crashes and why I think we're in one right now. I'm going to tell you what I've bought and sold recently and why, cover some of the company's recent earnings reports, and then finally tell you if I am thinking about sticking with these growth stocks or switching to a new strategy because I just can't take these losses anymore. All right, so first up on the month, you can see 115,864. We are down $6,800 on the month. That's down about 6%. I put in $27,000 this month. I keep thinking that this is, such a crazy drop in the market and it's such a great opportunity for the long term. And then the market keeps dropping more. Since February 15th, 2022, when I started this portfolio, I've put it in $131,600. You saw the current value, 115. So we're down 15,800 total. And it's been a tough stretch, right? Jumping back over to this month, we're going to cover the top gainers and top losers in the portfolio. And you can see Shopify was up 22% this month. They had a pretty strong earnings report that shows the business is turning around. And I just think that stock got way too cheap. Rocket Lab is another company. I'm a huge fan of this company. It's a small market cap company. They are launching rockets and satellites into space. They build space systems for their customers and even government agencies. And they have a huge market space applications that they haven't even began to tap into that should serve them with growth opportunities for the next decade or more. Mercado Libre, same deal. E-commerce, you could just kind of tell e-commerce went up this month, at least for me. Taiwan Semi, that's a relatively new position, was up 1.78% this month for me in my portfolio. And then Bill.com was up 1.8%. We'll go to the bottom and we'll just look at everything that was down 7% or more in this portfolio. GitLab, Mongo Database, Snowflake, and Datadog. And you can tell right here, this really just looks like these types of stocks dropped. Growth type of SaaS, software, enterprise software type companies just got hit. They had a pretty good month in September, and so this was just kind of giving some of that back. But right now, the bottom line is people just don't like unprofitable tech companies, okay? And then finally, Tesla down 18% over the month in my portfolio, and Meta down 40%. That's horrible. I don't know that the stock was necessarily down this month or this much over the last month, but I added to the position, and so that's why it's showing down 41% in my portfolio. That's probably everything I added or something like that. I don't know why exactly it's showing that like that, but it was horrible. Right now, we're going to talk about the history of stock market corrections and why I'm really not concerned about what's going on right now, and I'm not concerned about my portfolio. And then next, I am going to get into the transactions I made and where I think my stocks are going from here and why I made those transactions. So that'll be at the end of the video. All right, this is from Ben Carlson. He wrote this in January, but the data's really still the same, right? This summarizes my feelings about investing and the type of investor I am. It's important to remember this is just something that happens. He's talking about volatility and crashes from time to time in the stock market. The only reason you get high returns over the long run is because you occasionally experiences losses in the short run. This is a feature, not a bug. If the market always just went up, you'd never have an opportunity to have a good return because it just doesn't work that way. These pullbacks present oftentimes generational, life-changing buying opportunities. I'm not saying that's where we're at now and that the market's not going to go down anymore. I don't know if it is or not, but I can certainly tell you this is not when I'm going to be selling stocks. The average drawdown from peak to trough in a given year in the US stock market going back to 1928, given year, peak to trough, top to bottom, is 16.3% on average every single year. What we're going through is normal for the stock market. It doesn't feel normal because there's so much bad going on in the world and everybody's saying that these reasons and what's going to happen next. The potential for nuclear war, and that would be absolutely horrible, right? Like, I'm not taking away from the human atrocities that are happening in the world, but from an investing perspective, it always feels like a horrible time to be investing. It always feels like the next thing that's going to happen is going to make the stock market drop forever and never come back. And throughout history, at least since 1928, that just has not been the case. And even before that in the United States. So anyways, this is from 1928 to 2021. The S&P 500 they're talking about here experiences a 5% or worse loss in 95% or years, 10% in 63%, 20% or worse in 26% of years. So we're right about at this threshold for the S&P, and then we're down like 30% or more for the NASDAQ. And over this 72-year period, based on my calculations, there have been 36 double-digit corrections. So that's a bear market, 20% or more every 7 years on average. And the NASDAQ is even worse, a bear market, 20% or more correction every 4 years. It's the nature of investing in high risk, high reward type companies. And yeah, sometimes the NASDAQ just gets crushed. 1973 to 74, the S&P fell 48%, the NASDAQ fell 60. In 2000 to 2002, S&P fell 50, NASDAQ fell 78. So maybe I'm going to get crushed even more. Who knows? And Ben sums it up here, and I agree. If you're saving money on a regular basis, these corrections are a good thing. It means you're buying stocks on sale. Young investors should prefer down markets when they're in accumulation mode. I've been saying that this whole time. If you look back at pretty much all my videos, I've been saying the same thing. Now, I do not have any money that I might need in the next 5 years in the stock market for exactly this reason. This is how I invest. These are the types of losses and volatility over time that I expect. I know how it works for me, and everybody else should do their own thinking and own research and talk to financial advisors and make your own decisions. Don't just copy what I do or what anyone else does. And you have to know your own emotions and know yourself and if it's going to ruin your life to be down a certain percentage or not. That's going to dictate how you should be investing. Okay, and let's just show kind of where we're at, right? This is year to date. The S&P 500 is down 19%. QQQ, the NASDAQ's down 29%. And then when is this going to end? Where are we at? Again, I have no idea. That article, they have no idea either. But we can see that the S&P 500 at the end of the year last year, in December 2021, had a PE of 24. Its average PE is represented by this blue line since 2010. The average PE is 19. So it needed to come down, even if times were great, right? And now we've got rising interest rates, inflation, war, all that stuff. So, something needed to happen. And now we're trading at a blended PE of 17.37, which is down below its average over the last 10 years. But these last 10 years have been very favorable, right? During 09, the market crashed down to a PE of about 15. In 2010, it was down to a PE of around 15. So if I had to guess, I would say like the potential highest likelihood max downside for the S&P 500 is down to about an S&P or a PE of 15, which is 15 to 20% drop from here, which would be horrific and horrible. I hope that doesn't happen. Probabilities show it's unlikely that is how bad it will get, but of course it's possible, right? Now, there's also the risk that earnings expectations and just earnings come down. And if that's the case, then the price will go down, even though the PE goes a little bit higher, and it corrects to get the PE down back in line with where its earnings are and its earnings growth rate. So that's certainly a risk here, right? But based off current expectations for about 5% earnings growth through 2023, if the S&P 500 gets back up to its average from the last 10 years, you'd be looking about a 15.5% annualized return through December 31st, 2024. But even if it's down to a PE of 15 with 5% earnings growth, then you're looking at a 2.6% annual return. And so it's still not negative. And so again, I think like a lot of the downside, aside from some black swan type scenario, worst case type scenario happening, which I don't base my investing decisions around that. That's what my cash reserves for and other things. So outside of that, we have a relative margin of safety for the broader market, which means that stocks in general should do okay over the next couple of years. And so, real quick now, we'll just cover like the companies that have reported earnings since October 13th, and we'll start with Taiwan Semi, right? And this just shows if they beat their earnings per share expectations and revenue expectations. If it's green, that means they beat it. They came in at $1.79. They beat that by 11 cents. They beat on revenue, which was nice. And then their next earnings date is going to be around January 13th, 2023, with $1.75 in expected EPS. So a little bit down quarter over quarter. Okay, Tesla. They reported on the 19th. They beat on earnings. They missed on revenue. A lot of that claim by Tesla was kind of because of production challenges and challenges in China with shutdown factories and stuff like that. We'll see if this trend continues. Their next earnings date is going to be around January 25th, 2023. And they're actually expecting earnings and revenue to grow quarter over quarter. If you love this content, do me a favor, like the video. It helps other people find it, helps us get discovered. And then subscribe to the channel and turn the notification bell on so you don't miss these updates. I try to provide a real view of my portfolio, what I'm doing, the risks, the wins, the losses, and a long-term approach to investing. Again, without recommending anybody just copies me, but just to hopefully inspire more people to invest. And owning index funds or ETFs is a perfectly appropriate way to do that. I cover a lot of them on this channel, so just check those videos out. Meta was the disaster this quarter, this month, this year, the last 5 years. They announced on the 26th. They missed on earnings. They actually beat on revenue. We don't know when they're going to announce again, but revenue is expected to drop, and the EPS estimate, at least according to this, is actually higher than their last quarter. We'll see what happens there. And then Shopify was a nice surprise. We talked about the stock being up. They announced on the 27th of October. They beat on earnings per share, they beat on revenue, and their next announcement is going to be sometime in February. So again, I'll cover these all on the channel. Just make sure you're subscribed and follow along as we do the updates. All right, this is Savvy Trader. I share my portfolio on Savvy Trader, and if you subscribe on here, it's free. You can choose to get SMS and email updates anytime I make a transaction. So you could get notified of all my losing investments as soon as I make them. But the cool thing about it is you can actually compare a portfolio to indexes, the S&P 500. So we'll just do that. Over the last 30 days, I'm down 3%. The S&P 500 is, at least according to this, I'm down 3%. The S&P 500 is up 8.8%. And then even I probably align better with something like the NASDAQ because of the types of companies I own. It was up 5.5%. And again, I was down about 3%. So not a great month for me. And here is what I'm talking about those transaction updates, right? So you can see the things I've added to. I added to Rocket Lab. I added to Taiwan Semi. I added to Tesla, added to Mercado Libre, added to Shopify, added to Meta. I sold the Trade Desk, Airbnb, and Advance Auto Parts. Those are my most recent transactions, and let's jump into it. I'm just going to share a little bit about why. I am a fan of the Trade Desk. I'm a fan of Airbnb, and I'm a fan of Advance Auto Parts, so I don't think there's anything wrong with those customers or those companies. I didn't get a chance to get to Tesla, Rocket Lab, and why I sold the Trade Desk. Basically, I sold the Trade Desk because I just think that for its growth expectations, it's still got a very premium valuation, and it's a great company, but I just liked the opportunity better. Like I've been saying, Tesla, again, it's traded at one of its lowest price to earnings and price sales multiple of the last many years, and I think they've got a lot of growth ahead, obviously. And Rocket Lab is such a small company, so it is very risky, but they have an excellent record in launch. The space industry is expected to grow very strongly over the next decade plus, and I really want to be invested in such an innovative company. Let me know what you've been buying and selling down in the comments, and if there's any stocks you want me to review. Have a great day.